Hey guys, this is Sharad with REsimpli, host of the REsimpli Podcast. Today we have a very special guest, Mike Stohler, on this podcast. He's doing something very interesting. The first investor that we have on the podcast that's doing the kind of investing he's doing. So I'm very excited to jump into it. Mike, welcome to the show. How are you?
Thank you. Doing great. Thanks for
Yeah,
having me on.
yeah, absolutely. Our pleasure. Mike, before we get started, just tell us a little bit about yourself. Where do you live? What kind of investing do you do and how long you've been investing for?
Yeah, I live in steamy Arizona. I'm in Scottsdale. I think it's only going to be, 110 today.
Oh, that's not
So
bad.
I'm not bad. It's going to get hotter. It's. Um,
Yeah.
I started out. I'm prior service. I was Navy. I was an airline pilot for many years.
Thank you for your service.
And thank you. And a long time ago, I just like everyone did the read Rich Dad Poor Dad, and I was like, kind of got
Yeah.
hooked. That's probably 90% of us. Bought my first rental. I had 8 homes immediately and failed miserably because I got started PG. It's called pre-Google
Oh
days,
yeah.
pre-internet. I
Yeah.
couldn't Google how to be a landlord. You know,
Yeah.
I had no clue. What's a 5-day notice? What's a lease?
Right.
I didn't know anything. I knew how to buy and I knew
Right.
how to wholesale, but I didn't know how to do landlord. So failed miserably. Took a break, became an airline pilot, got back hot and heavy. Just my extra cash started buying. Then it went from fourplexes, and eightplex, 20plexes, 50plexes, 100plex. I mean, it just kept going and going and going and going. And then I was doing it with my own money. And then I got hooked up with a mentor. And ladies and gentlemen, just the mentors, the business mentors, everything is so important, to learn, learn, learn. He taught me how to use other people's money. I,
Yeah.
I, I had no concept. I thought, you buy a 50 unit, fix it up, wait 2 or 3 years, do a 1031. And I was like, oh, wow, I'm going to be 80 before I make any really good money doing it myself. So he taught me how to do my own. And then I had a portfolio, and some 1031 group out of either Iowa or Idaho came in and said, hey, I want to buy these. And I'm like, not for sale. Because now I'm finally I can golf every day. I can do what I want. I was making a pretty good living. I said, man, I'm comfortable. They kept coming back, kept coming back. And finally I was like, oh man, I am an idiot if I don't take this money, because, you're making 7 figures. I made 850,000 on one complex that I had for 10 months,
Wow.
netted. And I'm like, oh, these guys are just crazy. But then I got to thinking, why are they doing this? And I looked at the cap rates and the compression. And here in the Southwest, things were getting that 3.5, 4 cap on multifamily. And I'm like, oh man, what do I do? Now I have this huge chunk of money. I was used to buying at 8 caps, 9 caps, and that's how I got started in hotels. So I transitioned to my 1031, and how I got started in the hotel business. I found a guy, it's all about networking. I found a guy that had about 25 years experience in hotels. And I told him, I said, look, we're going to use my money. You're going to find me a hotel. You're going to run the hotel. I have no idea. You're going to teach me everything. And I'll give you a cut on the back end for helping me. And he's like, sure. I mean, it's what I do anyway. So you're telling me that you're going to buy the hotel and I get a cut? And I said, yeah, it's all about performance based. And we still have that hotel and it's doing fantastic. But that's how I got from one house to a lot of apartment complexes, hotels now. We're having
You
fun.
make it sound so easy. Yeah, I bought a
No,
house, then I
no,
bought 4 unit, then I bought a 20 unit, then I bought a 50 unit,
no.
then I bought a hotel. Yeah, you're like,
I
yeah,
had
this is
hair. I used to have hair when I started in real estate. Ladies and gentlemen, it's
oh,
not easy. This is
yeah.
not an HGTV episode.
I know it's
You
great.
don't get it done in an hour.
You seem
Um,
like the kind of person, hey, I'm just going to take action. I'll
yeah,
figure out. It's better to take action than kind of be 100% prepared and then you miss the opportunity. So I love that.
yeah,
So let
absolutely.
me
You can't do the analysis paralysis. Oh,
100%.
one more seminar, then I'll be
Yeah.
ready. It's like at some
Yeah.
point, come on,
Yeah.
just
Yep.
do it.
No, 100%. So what market were you buying these properties in? And what was the time period for these?
The hotels are the single family or the multifamily,
The,
which
the single family and
yeah,
multifamily.
Midwest. And then we transitioned out here to Arizona. And then I really made the big bump during the last recession.
Okay.
Um, and that's when I started getting into the bigger ones.
Right.
Because in the commercial space, you have 5-year loans, they mature in 5 years or they reset.
Yeah.
And, I had some cash, I'd sold some stuff. And so what happened is all these loans were coming due. They were valued at 40% of what, these are 100% occupied performing notes, apartment complexes, but they wouldn't refinance them. The banks were actually saying, we're not financing anything right now. And it came up and they said, well, now it's worth 1 million instead of what you owe,
Right.
which is 1.8. You have to come up with the difference. And
Okay.
so there's all these
So
people.
that's where.
That's how, and then I was like, oh, I can come up with the difference. And sometimes I did seller financing. I did look, I'll help you not go bankrupt and get foreclosure. So yeah, I did some outside of the box type financing to
Yeah.
really buy and leverage a lot.
I really want to talk to you about the hotel investing, but before we get into it, this is like you said, pre-Google that you got started, which is really, really amazing to like just you're casually saying, oh yeah, I was bought 8 houses, then I kind of lost money on it, then I started again and bought 4 20 50 unit apartment
Yeah.
complexes. How did you gain the confidence and the knowledge to go about this? Were you part of some investor group in your area? Were you part of another mastermind, not real estate related? Were you working with a coach? Like, how did you, I mean, it's not an easy
Well,
thing for you.
I was small town Indiana. There's no coach.
Yeah.
There's no winner. There's no Googling how to do this and that. I just knew I saw these big fancy homes on the lake and I knew a couple of them and they're like going, why is it there's this real estate thing?
Right.
I knew from the books that I read. Ladies and gentlemen, went to the library, checked out books. That's what we did back then. And I read and I was like, I know I failed. And we failed so hard that, we had to actually move into my wife's parents' house. So I'm one of those guys that's not these YouTube sensations. I made 7 figures in 30 days and you can too. Look, if you don't do it right and you don't have the mentors, you don't have the coaching, it's easy to buy. You just go out and buy it. But what do you do after that? So I failed. But I knew in the back of my mind, what I did for a short period of time is I was like, how can I gain the knowledge? So I actually went to work for a property management group.
Got it.
Okay.
Wow.
Stole their forms, learned how they did it. Here's the application. Here's the
That's amazing. You were getting paid to be educated.
Yes. So that's what I was like going, how can I do it? I need to learn. I learned how to fail. How can I learn how to do it correctly without the internet? And what do you do? Hands-on experience. And, these people had a lot of apartment complexes and I started managing some of their apartment complexes. And that's where I learned. And I was like, okay, this is how you do it. So that gained my confidence to go out and buy. And, something that I did, and you're talking about groups and things like that. A lot of your listeners maybe not know this, but what I did is there's a small university in our town and they get bequeathed homes. It's the alma mater, and they just get bequeathed in someone's will. This is their alumni and they just get these homes. And I met with coffee with the guy one day, this person that's in charge of their real estate. And I was like, hey, I want to buy these. You become the bank because you don't want to be a landlord. I'll buy them. You become the bank at, whatever percent interest for 5 years, and then I'll get a bank note. And that's how I got a lot of good deals on real estate because these universities don't want these homes.
I had no idea about that.
Yeah. So, for your listeners, if you're in a small town or even a big town, find out who's in charge of the real estate because there's going to be homes that they don't want.
Amazing. That's the first time I've heard that as a deal source. Thank you for sharing that.
I actually bought a fourplex from the university.
It sounds like you were doing pretty good after your initial failure. And thank you for sharing that, by the way. You were doing pretty good after that. You're doing great with single family, multifamily, why hotel. That's very unusual. Like people would just keep scaling their multifamily. But
the biggest reason is because it's unusual. Less competition.
How do you even go about buying a hotel?
It's the same as, it's not the same as multifamily. I do franchise. Most of them are franchise hotels. The ones we have we have one in Spain and another one that we're getting ready to buy, do a syndication for they'll be high-end boutiques, so they're independent. But how do you do it? You have to have experience, because you're not going to buy a Hilton, say, hey, I'm a multifamily guy, I'd like to buy a Hilton. And they're like going, yeah, go away. So you have to have experience, someone. And that's this partner that I told you about. I ended up doing a JV agreement with him on that first hotel because he needed to be on the note. He needed to be on the franchise note because they didn't know me. He had 25, 30 years experience. So you have to have someone that knows what they're doing before Hilton or Marriott or whoever trusts you to run their franchise, because we are the face of their franchise. If we run it into the ground, it looks badly on the franchise. And then you have to be approved by the franchise. You have to be approved by the banks. It takes probably 6-7 months max to close a hotel. There's just a lot of due diligence. You have employees. That's the difference between multifamily and I may have 12 to 20 employees at one hotel. A lot of vendors. So it's just a lot. Look at the due diligence that you do on multifamily and times it by about 6.
Okay.
That's the due diligence that you have to do on hotels.
Can you walk me through like financials of a hotel? Like just walk me through a deal example of what does an average deal look like for you when you buy a hotel? I'm really curious. Like it sounds like it's a lot more work than multifamily, but the ROI must be good enough for it to, make sense.
Well, I pulled up one. I just got back from Tulsa, and I'm looking at opening up a syndication. Probably be opened up in maybe 2 weeks. I just have to do the deck, and do the paperwork. But I'm looking at this hotel in the Tulsa area, and it's $6.5 million. Okay, 30% down. And when you look at the cash flow summaries, the depreciation, here's something else with the hotels is I get to do cost segregations. If your audience doesn't know what that is I can accelerate my depreciation, all of it, because in the hotel, it's like every lamp, every desk, every stapler, all these different things has a depreciation schedule. And then I get to accelerate it. And that is a huge tax savings on like the K1s for people who invest on the limited partners. I look at all the expenses. I have, the property management group that I work with, and we look at how can we, this is the same as multifamily, how can we change the expenses? How can we save on these expenses? Do we have any leverage on the vendors that we know? And like, for instance, this deal that I'm looking at in we use like leveraged IRR to look at.
What's that? What's a leverage IRR?
So it's internal rate of return based on the leverage
financing
part, because the financing in the equation instead of just buying cash. You can just say, hey, here's IRR based on cash, and we're not going to buy this type of asset for cash.
So it's a $6.5 million hotel. You're putting roughly about $2 million down, right?
Yeah.
You're getting a loan for about $4.5 million, right?
Yeah, it's like around, I think, 4.5 million. We raise a couple $100,000 for capital costs, for the oh crap, we didn't know about that once we get into it, so we want at least 2 months of cash flow, because you don't know what you're getting into. There's always surprises.
So you're getting commercial loan from the banks. How are the loans different? Are these like 30-year amortization or 25-year amortization?
Great question. So one of the biggest difference between hotels and multifamily is hotels are considered a business. Okay. It's a business that sits on real estate. So we have two different plays. For instance, like during COVID, I was able to get PPP loans, EIDL loans, small business grants, and that kept us afloat during COVID. The leverage part, there are a lot more different types of loan options out there for hotels. I can do a conventional. I can do SBA. I can do CMBS, which is a market-based security. There's insurance groups.
What's an average interest rate on
right now? And that's why there's just it's why we're not buying a lot. We're looking at around 7.5.
Okay, that's kind of on par with what you would get on the residential commercial. And then what's the amortization period?
25 years.
Like, it's the loan term for 5 years?
Yeah, it's either 5, 7, or 10, just depending on.
7. Okay.
But most of them are 5 to 7 years, and they just do an interest rate reset.
Okay. Every
So
5, 7, 10 years.
yeah,
Right.
so it might
Okay.
be a 10-year loan that resets at 5 years.
Okay.
Okay.
Got it.
That's
All
standard.
right. All right. So you're putting 2 million down, getting a loan for about 4.5 million, and plus you have another 200,000 for, oh crap, we missed this. What
Yeah.
happens? Like, how much revenue, would you expect on a monthly basis? What would your expenses be on something like this?
Well, I don't really go by monthly. I know that first
Or just
year,
like however I'm
like
really
my
curious however you
NOI,
get.
we're
Yeah.
looking at an NOI of around 660,000 year one.
Okay.
Okay, that's so NOI is around 660. My annualized debt payment is going to be around 410,
Okay.
I think, based on that. And then you have, and that brings us down to what we look at as the debt coverage ratio. We want it
Okay.
to be above 1, of course.
Okay.
So it gives us a debt coverage ratio about 1.6 and a debt yield of 14.2%. So we look at the debt yield based on what our debt coverage ratio is. When I go in and look at buying something, I do this analysis and see if is it big enough for stuff to happen.
Okay.
And then I'm looking at cash flow after the debt service after year one of about 250,000 will be our cash flow.
So if you were to go out, pay cash for this 6.5 million.
Yep.
And you're making about
660.
10%.
About 10%.
No, not 10. Yeah, about 10. Yeah, about 10%.
It is. It's about 10, a little over 10%.
Okay. And then how do
Okay.
you go about like adding efficiency in a hotel business? Is that like negotiating with the vendors on lower rates?
It is. It's
Increasing
looking.
Your
You go
average
in and
nightly rate?
immediately look at sales and marketing.
Okay.
What are they currently doing? I noticed that in this particular hotel, they don't do any type of work with the franchise. So the franchises have their own team that help in just sales and marketing. And it's kind of like a gas station. The difference between multifamily and hotels is I can change my rate 4 or 5 times a day, every day.
Okay.
Okay. Where you're stuck in a 6-month or a 12-month lease at $1,000 a month or 1,500, 2,000 a month. If a concert's coming in, it's 200 a night. During the busy, it could be 150, it could be 80. I'm just changing it. You can do, they're special. So we go in and we hook up. And I noticed with this hotel, how can we do efficiencies? Well, they're not using the franchise sales and marketing platform. So they don't know. It's like, how do you determine we call it ADR, your average daily rate. How do you determine that it needs to be $110? They're like, well, I don't know. We kind of look up, see what the competition's doing and da-da-da. And I'm like, oh, wow, okay. Boom. There's a lot of efficiency we can use by using our analytics. And we have software internally, plus using this franchise's software to really fine tune the ADR. Okay, that'll increase the occupancy because we're constantly kind of moving it around. And then we look at our comp set and see what they're doing. And the franchise will have the ability to look at our comp set, which is all the other hotels in our type of class within maybe a 3-mile or 5-mile radius.
Yeah. Okay.
And then it's just kind of like what the gas stations do. What's a Shell doing across the street? And right. So they're just kind of playing with each other. And we can do that through analytics. We look at the vendors that we use. Can we bring anything in-house? Why are they spending this money on this? Is it required by the franchise? So we just go in and analyze every line to see what kind of efficiencies we can use. We just know that we kick butt in our property management. How can we be more efficient with that?
It's the systems and processes where you gain efficiency, and then even like 5% efficiency is going to have huge impact.
Absolutely. And then we look at cash on cash return year one on this one is going to be about 12.5%.
Okay. What's the goal with like a hotel business? Is this used for long-term wealth, or is it something you come in, you buy a hotel, add some value to it, and then essentially flip it to another investor? Is that kind of, is there, when someone starts out wholesaling, right? Their goal is they're wholesaling, then they'll do some fix and flip, but eventually the goal is to buy rental properties to build long-term wealth. What does that look like in the hotel business?
Hotel business is a little bit longer because it is a business. Okay. It's hard with a franchise to put lipstick on something. Like if I'm buying a Hilton, it has to be a certain status. It has to look very good. There's not a rundown Hilton or Marriott, right?
Right.
So these are longer term deals, patient capital. The investors that I deal with in hotels they're diversifying their portfolio. They don't want quick cash. They don't want these quick distributions. They want something that they can park. That something is going to appreciate. It's going to make them money, but it's going to be 7 years. I have the ability to sell in 5 or 10, but then at the end of the 7 years, I can do a cash out refi for those investors that went out. I usually have several investors that say, hey, I want to be part of that smaller group, so they hang on to it, and then we hold it on, for another several years.
It sounds like in terms of deal structure, it's not very different from multifamily, but it's just the due diligence part is where you make or break, right? You really need to go through every line item, and the value add for you when you're buying a hotel would be if someone has average daily rate ADR of, let's say, 100, you could see they're not using the right analytics, and you could charge 110, 20, 125 immediately.
Bringing in sports groups, getting corporate contracts. Truck driver contracts, depending on where the hotel is. So you're going out and getting contracts that are going to fill up 10 to 15 rooms a month. And you do enough of those. And then you look at travel teams, you look at the concerts, and you go with the venues and say, hey, if they're coming to your concert, this hall or this athletic field, they can stay at our hotel and we'll give them 20% off the room rates. It's just doing these different types of contracts. And then sometimes, we'll change the franchise. If it's a franchise we don't like, that we know that there's something else that could be there. Let's say it's a Radisson or a Wyndham Red Roof. And we know, and because I know the regional directors of development for all the basic franchises, and I contact them. It's like, hey, you guys want a Hilton? You guys want a Wyndham here? And they're like, oh yeah, we do. We really need one. It's like, okay. And then we negotiate with them to give us a deal, because there's going to be some type of a contract break, right, with the old one.
Right.
But just by switching a franchise to someone like, for instance, Radisson has very, very small amount of reward members. Okay. Wyndham has 100 million reward members. So I have 100 million potential customers if I go, and the same with like Hilton, Marriott. But some of these smaller franchises, you just kind of switch, because just switching to a different franchise immediately bumps the ADR.
Absolutely. Yeah. Okay. No, that makes sense. Yeah. So let's say someone listening to the show, right? They're intrigued. They're doing some multifamily, and they want to start. They're curious about hotel investing. Where does someone even start? Like, do you go to LoopNet, or where do you even go about contacting hotel owners?
Boy, what you do is you contact an owner that that you trust, and say, hey, can I shadow you? How can I become? The best thing is become like a limited partner in the hotel. So then you learn from our reports and how we analyze things, because once the syndications open up, there's just all this reporting and this open book. That's what kind of sets us apart from like these big REITs. Is my investors know my cell phone number. They know my email. I give them just reports and reports and reports, and they're learning. And some of them I meet with every quarter, my investors, because they're learning. They're like, and they'll have a stack of papers, these questions for me.
And these are accredited investors?
Accredited investors. Okay. Yeah, I don't, for right now, I just, accredited. I don't want to deal 6 months from now, say, hey, Mike, I need my money back,
What's the minimum investment you require?
It's usually 50,000. So it's not that, it doesn't need to be that high. Most of the people give us a couple hundred, 250. A lot of them 150, but I get some that are 50,000.
What does average return look like for an investor who's putting money in a hotel?
The average cash on cash is about 15.7. We're around 15% cash on cash returns The way we set it up is like an 8% preferred return.
Okay.
Okay. So you get 8% immediately. And then it'll be like an 80-20 split, 80 to the investors,
Okay.
20 to the GP.
Okay.
And that goes on, depending on the deal. It can be monthly returns, quarterly returns. It depends on how much money it makes and whether, and like here in Arizona, we usually don't do distributions in the summer because you're not making anything in the summertime. No one's staying at
Okay.
our hotels when it's 110,
Right.
So now we're saving money. So then, it'll distributions start back up. So that's it. It's usually 8% preferred, then an 80-20 until all the capital's paid back.
Okay.
All the investment capital's paid back, and then it's just slush.
Got it. Wow, it's not bad return at all. Like,
well,
yeah.
When you're looking at multifamily versus now, I mean, this is now, even with the higher interest rate, we're looking at a 27% 5-year leveraged IRR.
Wow.
Okay. So when you're looking at a 27% IRR and a 15.7 average cash on cash return, that's the difference between multifamily, because it's
Right.
the cap rate. We don't really go by cap rates in hotels, but if you did, it's just a lot higher than multifamily.
Right. So as an investor, if I were to give you, let's say, $100,000 in this project, right? I could make about 12 to 15,000 on it every year, and it's paid either monthly or quarterly. Is that right? Am I understanding that correctly? 8% would be preferred. So on 100,000.
8% is preferred, and then so you're getting that on top, and then whatever's left, you get 80% of that distributed among however many investors.
Okay. As an investor, do I get anything on the back end?
Oh, absolutely.
Okay.
Oh no, absolutely. Yeah, I do. Ladies and gentlemen, if you ever look at any type of waterfall in a syndication, if there's more than maybe 2 waterfalls, really check out.
What's a waterfall, if you can explain?
Oh, sure. Absolutely. So here's the way that I work this syndication. It's 8% preferred return, right? And then you have a waterfall. So you have a trick. What happens next? Here's the pond up here, and it's 8% preferred return. And then it kind of falls down to the next batch of money. And that's called a waterfall. And that's the 80-20 split.
Okay.
And then you could have another waterfall that says, if we make more than 15% or 20%, then it flips. I get 80%, you get 20. And then you could have another waterfall. So the more waterfalls, what happens is the sponsor or the GP is trying to find out how they can make money.
Got it. Okay.
Okay. So it's like, if this happens, it changes the deal. If this happens, it changes the pool, the pot. I do one waterfall because it's like, look, the investors are number one. Okay. I don't make my fees or any type of distribution or any of mine if they don't make it. Okay. I'm probably the only GP in the world that does that, because most of them just sit there and just say, we'll run this asset into the ground as long as I get my fees.
Right.
Okay. I morally, call it my Midwest upbringing, I morally can't do that. Like, so in the summer, for the hotels I have in Arizona, I've contacted my CPAs and my bookkeepers and say, cut off all of my stuff, because now we're in asset protection mode, right? I mean, everything's fine, but we know that it's going to be probably lose money during the summer months in Arizona.
Right.
Okay.
Yeah, because no one's traveling there. Yeah.
No one's traveling. So how could I ever feel good about, hey, still give me my 2% here, my 1% here, my different allocation fees.
Right.
I just can't do that. I just morally can't do it. So once it comes back up, then there are fees that I get, 1% here, 2% there.
And what's your goal looking ahead 3 to 5 years down the road? Like, what do you see yourself doing?
Sure, great question. So I'm getting ready to do syndication on probably this one. That I'm not going to give you too much detail, but I've given you the numbers. Probably open up this syndication. We're getting ready to open up an international syndication. So those of you that think it's sexy to own a castle in Spain, we're getting ready to open up a syndication in Catalonia, It's about an hour and a half northeast of Barcelona. Catalonia is the whole country. It's very, very interesting why we're going international. People think it's like, oh my God, why would you ever do that? It's a lot easier to work with. We've gotten so complicated here in the USA with people not wanting to work, or they're wanting too much money to work and they want to only work 4 days, taxations, all these different things that just the cost to build, the cost to maintain here in the United States. I can buy this castle is an estate that was built in 1610.
Wow.
And it's on 107 acres.
Ooh.
And it's going to be, what we're going to do is a high-end boutique. Okay. And it's going to be that destination wedding. It's going to be that corporate retreats. I'm not too interested in renting it out nightly.
I do. Yeah.
Okay. Whether it's one person or 18 people, you just buy the whole place per night. And that's going to be phase one. We're just going to go in, buy, and there we just go in and buy cash. Okay. We're not going to have any leverage on it at all.
I'm just curious, what would something like that cost?
If you can believe that, all in, buying it, renovating, paying off the 85-year-old owner, 107 acres. It's a 9-room castle built in 1610, all in, $2 million.
Wow. That's amazing.
And it's amazing. And
yeah.
So, but here's the thing is they're trying to get outside. If you look up BlackRock, if you look up these huge REITs, they're all doing articles on why they're going into Europe.
Interesting.
They're taking kind of a break here in the United States. And Spain is one of those big places. The southern part of Europe is really, really big. And we're looking at Spain, Portugal, Italy. We're staying out of Britain, Germany. We're looking at Portugal, but Germany and England is more U.S. prices.
Okay. And the taxation is high also.
Taxation is a lot higher, and they're giving us breaks. And phase two, what's really, really big in Spain, we have 107 acres. We're going to put little yurts or pods spread throughout the forest. So it'll be phase two, and the van life, the camping life, there's going to be all these different things.
I'd love to see pictures of it. Yeah, that sounds amazing. For $2 million.
It is. $2 million. Yeah. And if I showed you pictures, you'd be like, oh my gosh. Wow. It's like, I want to live there so bad.
That's amazing.
So that'll be a really fun project. And it doesn't cost that much to get in. It's $2 million. And what's great about there, you just need a caretaker.
Yeah.
You need,
you would just have someone local taking care of.
Someone local that'll live on site. Caretaker, and like a married couple. Someone does some of the maintenance, the housekeeping part.
That's perfect. Yeah.
And that's all you need. That's all you ever need.
Go ahead. What I love about you? It's just like you love taking action. It's like, yeah,
it's fun. It's addictive.
Yeah. I totally get it. It's just, you love taking action. Like, just think big, take action. We'll figure it out. I love that. But I'd
still do a lot of the analytics.
Yeah, of course. But then you just have that addiction.
But then it's like, well, here's the whole thing. Just do it. Something else I'm getting ready to build, if it ever gets approved. I'm getting ready to build a big luxury hotel here in Arizona. It's going to be the heart of everything. There's a lot of approvals that need it. So, everyone, if you're interested in luxury, rooftop bar, that'll be more like a $25 million project. So we're getting ready to do that. But so we're busy. We're busy. The team is busy, but we're having fun. We're finally getting to the point out of COVID where things are starting to happen. I just need someone somewhere to wake up and fix the economy and interest rates and inflation. Just figure it out.
I think it'll be interesting with the election year. So kind of how that unfolds, how that starts affecting things, the real estate market and economy at the macro level. So, Mike, this has been absolutely incredible. We just have a couple of more questions to ask you.
Sure.
What do you do for fun? Buying hotels and stuff. Other than
Look at hotels. What I'm going to have fun is going to be able to go to Spain to look at my asset, and it's all going to be tax deductible. That's fun. So that's another thing that people don't realize if they invest in the Spanish asset. It's like going, hey, Mike, I need to go and visit my asset in Spain. It's like going, yeah, it's a business trip, right?
Yeah.
But yeah, I like to maybe play guitar
Yeah.
a little bit. I'm a golf fanatic.
Nice.
I
Yeah.
like to hang out. My downtime, I love to hang out. We have a place up in the mountains. I like to just go out on the porch and stare at trees
Yeah.
for like an hour and
Meditate.
just meditate and just.
Yeah. That's amazing. What's the one book? I think I know the answer to this. What's the one book that's had the biggest impact in your life? It could be business, personal,
Yeah.
or one of each.
There's two, Kiyosaki's book, Rich Dad, Poor Dad, but then
Yeah.
the book by John Burley, it's The Money Secrets of the Rich.
Money Secrets of the Rich. Interesting. Yeah.
And what it does is it teaches you, once you start getting money, you have to change the thought process. You see all these Instagram 20-year-olds that make millions and millions and millions, and they're buying Lamborghinis, mansions, da 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 da. You know what? Instead of a Lamborghini, I'm going to buy another house. I'm going to buy another hotel, and then I'll be able to, the money will come, and now I have just passive income. I can do whatever I want. But that flipped the switch on how the wealthy think.
Right.
And that was a really good book.
Yeah. Thank you for that. Yeah. I'm reading Psychology of Money. I forgot the author's name, but I was looking for another book recommendation. So perfect timing on that.
It is.
Right. If you could spend a day with one person, dead or alive, who would you want to spend the day with and why?
Dad would be one of my grandpas because I miss him so much. He's the one that taught me how to fish, how to hunt, get on the canoe, and just go out and just have a good time. Alive, you know what? My God, how crazy would it be to spend a day with Elon Musk?
Oh, yeah.
You just wouldn't, you're just like, I'm just going to go into it, and you just don't know what is going to happen.
Yeah. Yeah. All the crazy things he's got going on. Yeah, you might be, you guys could talk about maybe opening the first hotel on Mars. That would be a good time.
Exactly. Yeah.
Cool. Mike, this has been absolutely incredible. Yeah. You're the first person on the podcast talking about hotel investing and buying a castle, building a luxury hotel. I absolutely loved it.
Yeah.
If someone wants to connect with you, learn a little bit more about your journey, what's the best way for them to do that?
Company's Gateway PE is in private equity. Gatewaype.com is the website. I have my own podcast, The Richer Geek.
Perfect. Yeah.
And LinkedIn under Michael Stohler. It's perfect.
Perfect. We'll put all of that in the show notes. Mike, thank you so much for coming on the podcast. This was absolutely incredible. Thank you.
Yeah. Thank you very much for having me.